Hi, this is Rob Barnes with Integrated Insurance Consulting. Thank you for taking time to learn more about long-term care planning and protection with us today. You were likely invited to this portal by your financial advisor, or perhaps you are an advisor that's working with us already. I'm an insurance expert, and for more than 25 years, I've been helping advisors serve their client protection needs. Today's conversation is about long-term care. We'll look at the potential risks of needing it, the costs of paying for it. We hope to inspire you to have some conversations and create your plan. And as with other risks that are too great to retain, perhaps you transfer the risk and look at today's long-term care insurance options that are available. And at the end, I'll share some perspective as well. So one of the most widely stated statistics about long-term care claims is that when you reach age 65, you have a 70% chance of needing care during the rest of your life. Now you actually have a 50-50 shot, 50% chance of needing care for 1 year or less or not at all. And then, of course, the other 50% of needing care for a longer period of time. What we know today is that on average, women need 3.7 years of care and men need 2.2 years of care. But it's the other half of the pie chart that concerns us all, especially when we hear the words Alzheimer's and dementia. These are often the ones needing care for 5 or more years. I watched two longtime friends suffer through dementia with a parent, and then I got to watch my dad deteriorate over 8 or more years. He passed in 2023. And one point I want to make about all these statistics that float around is a lot of my dad's care happened under the radar. And so I think that some of the stats that we see are even longer because of informal care. And I'm not even sure when we knew about his condition, quite frankly. It might have been the first time that he got lost walking the dog. And so some statistics from one of our carriers, Mutual of Omaha, they have the average claim as age 79. They've had their youngest claim at age 27. So this is an older person situation, but diseases or accidents can cause young people to need care during their lives as well. We know that women get 70% of claims out there, and the primary reasons are dementia, heart disease, and arthritis. Half of all claim dollars are going towards cognitive issues these days, and 74% of claims start at home. But often, as you deteriorate, you might need more formal care. The words dementia and Alzheimer's can strike fear in our hearts. The reality is the statistics are scary. We want you to have a plan and a family discussion. It's a very emotional subject and hard to watch it happen to our loved ones, I can assure you. I appreciate the fact that my niece's husband was a nurse and is a nurse and helped bathe my dad. But I don't think I'll ever get the last few weeks of deterioration and his struggle to breathe out of my mind. It is a very indignant situation. So I encourage you to address the issue, discuss it with your family and financial advisors. It's best to discuss this while you're of sound mind, and I hope this presentation encourages you to formulate your plan and document your desires. Use logic and reason to guide and formulate your plan. Most people want to be cared for at home. Depending on the amount and depth of care you need, this could be a lower cost way to go. But it also could be the highest form of cost if you're getting 24/7 around the clock help at home. Although an LTC event can happen at any age, it's most likely to happen later in life. And on our EDU portal, we share a cost of care resource so that you can see what care would be close to you at different levels of care. There's two vital questions that are best answered before care is needed. Who will care for you, and how will you pay for care? Is it going to be self-funding, your family, the government, or insurance? Let's look at each one of these and how viable they are. If you have millions of dollars of assets, you may have enough to pay for any level of care you need. It's great to be in that position. But I encourage you to look at insurance options as they may still make sense. You take some of your assets or income and protect the rest of your pile by leveraging them into tax-free dollars. If you're not sure you'll have enough assets for any type of care, then insurance leverage may have even more value for your situation. And some options will deliver bond-like returns tax-free even if care isn't needed. And so the question is, will you have enough? What accounts are you going to draw from? What will be the cost of liquidating those accounts? Are you using a reverse mortgage? Are you tapping your IRA funds where you're going to have to pull tax out for every dollar you need for care? And if you're using your stock portfolio to pay for care down the road, if it's in a down year and you have to access cash, then it can spend down even faster with the shrinkage of those losses. And for those who have any legacy plans for your children or charitable recognitions, you might want to set those up irrespective of your long-term care planning so that you can accomplish everything that you'd like in your goals. I realize how uneasy conversations of death or disability can be. I've made it my life's passion to place safety nets under people so they don't fall too far back down the financial ladder when what if becomes what now. I often hear the kids are going to take care of me. But when I ask if you've discussed it with the kids, the answer is often no. And so hope is not a plan. And as much as this might be an attractive option for you, the question is, do you want the kids to have a choice? If you don't have enough for the care you need, then the kids might not have a choice and may feel obligated to care for you. For many families, the family care method is a viable option. There are insurance policies that can provide benefits so you can pay your spouse or kid to be your caregiver if desired. And some people believe the government's going to take care of them, and this is only available under two circumstances. Medicare will pay for up to 100 days of care, but only after a hospitalization, when you go straight from the facility to recovery or hospice. And Medicaid only pays when you spend down most of your assets. So we're accustomed to transferring risk when the risk is too great to retain. We do this with our home and auto insurance, and perhaps it makes sense to do with the potential for chronic care costs as well. There's a lot of threats to a smooth retirement. The biggest fear for many is running out of money. And of course, the need for chronic care can accelerate that issue. So too many are looking at each retirement threat individually in a silo. And perhaps the question is not should we or shouldn't we insure for each risk, but which risks should we insure and which ones will we retain. I encourage you to learn about the different long-term care options available today. If it makes sense to insure, you want to do it while you're still healthy. So long-term care insurance products are about asset protection. They're about asset leverage. They're about protecting your family and providing dignity and peace of mind. On our website, the EDU portal, we have a discussion guide for long-term care, and it'll help you answer the questions: who will care for you, how will you pay, or should you transfer the risk? Transferring the risk, there's three options available today for long-term care long-term care options, I should say, insurance options. There's pure protection. This is traditional long-term care. It's best to analogize it to auto or homeowners. You pay, and pay. Rates can go up down the road. And unless you have a care event, you don't get anything back from them. Today, hybrids are more popular than pure protection because they guarantee pricing and they guarantee some payback, even if care isn't used. And then there is a known outcome. You can buy a life insurance policy with a long-term care rider. You can buy a guaranteed chassis, protect yourself from future costs. And the bottom line is that death benefit is going to be paid out for care or when you pass, or a combination of the two. Whatever isn't used for care will be paid to your heirs. So it's a known option for people. If you want to better understand how each long-term care option works, I recommend that you view the video and read the article titled Exploring the Options on our EDU portal. That's where the costs of care is located as well. And so what I hear from people is, I'm covered with Medicare, and we mentioned earlier, you're not. It's only 100 days that they'll cover. We want you to be aware of that. And if you're thinking that the government's going to pay anyway, Medicaid's the other option, which means you're spending down most of your assets before they're going to take over. As far as those thinking that it won't happen to you, hey, you might be right, but the stats tell us otherwise. It's more likely than not, as we age, that we'll need some level of care, some length of care. For those that have enough to pay for care, great, but under any or all circumstances is the question, along with all the other retirement threats of inflation and what your assets actually grow at and so forth. Those are all concerns. And the less you have, the more you might want to consider some insurance to boost up the positive outcome that you won't run out of money and you'll be able to get the care that you need. Now, I hear from usually males on this one that I won't go into a nursing home. Some have told me they'll go get a gun, and my first question back is, what if you don't remember where the gun is? The reality is you don't control. We could have an event like a stroke that causes you to need nursing care. And even if you can have a milder situation and get care at home, sometimes as that condition progresses, you'll need assisted living or actual nursing care. So for those thinking they can out invest and do better than long-term care insurance, you might be right, but only hindsight is 2020. And we'll not necessarily know today that you bought the best product for your situation of tomorrow. Only hindsight's going to tell us which option would have worked better. But they all three options for long-term care insurance all accomplish the same thing. They take some of your money, leverage it into a bigger pool of care, and make that tax-free available to you. So protecting the rest of your assets and some of your income. And if you're kicking the can down the road before you explore the insurance options, it takes more than money to buy the insurance. It takes good health. So examine these things while you still are healthy and consider if leveraging for tax-free dollars makes sense for you. And for those that have legacy goals and limited assets or net worth, again, you might want to set those up, put things in an irrevocable trust, gift them to the kids while you still can, to make sure that you can accomplish those goals no matter what type of care you might need during the rest of your life. And so the question becomes, should you remain self-insured? And we look forward to helping you examine the insurance options and determine whether or not any insurance for long-term care makes sense for you and your family. So we hope that you consider how long-term care is a family and lifestyle concern. Have the long-term care conversation with your family. Think about how your portfolio could be impacted by a long-term care event if things don't go as planned. Evaluate whether insurance should be considered as a funding option. Call your advisor to review your financial plan, and give me a call if you want to discuss the different insurance protection options and better understand how they work. So I appreciate you taking time to learn today, and hope that you formulate your plan, document your desires, share it with your family and other stakeholders. Thank you for listening, and enjoy the rest of your day.